the forgotten architects of American credit. Their names rarely appear in textbooks, yet their influence shaped the very heartbeat of the nation's economy. In quiet offices, above busy shops and behind unmarked doors, they built invisible networks that determined who could borrow, who could grow, and who would be left behind. And for decades, their work unfolded in the shadows, guiding the rise of American credit without ever stepping into the spotlight. To understand why their story matters now, we need to return to a country still stitching itself together through trade, ambition, and uneven opportunity. The banks of the era were powerful, but not omnipresent. They served cities, industries, and large commercial interests. But between those towering institutions and the everyday citizen striving for a foothold existed a vast, unregulated frontier, one filled by private lenders, note brokers, credit dealers, and local financiers who improvised the rules of borrowing long before the nation settled on standards. These figures were resourceful, adaptable, and deeply aware of the changing rhythms of American life. They financed small stores when formal banks hesitated. They extended credit to farmers whose livelihoods depended on harvest still months away. They backed entrepreneurs whose ideas were too unconventional for traditional lenders. In many places, they were the only bridge between ambition and possibility. But their growing influence came with complications. Each financier created their own system for evaluating risk, tracking debts, and determining who deserved trust. Some relied on reputation. Others used sprawling webs of personal connections. A few built early forms of credit reporting, rudimentary systems that would later evolve into national frameworks. Together, they formed a loose ecosystem that kept commerce moving, even when banks faltered. Yet beneath these early innovations lay structural fragility. Their operations were scattered, inconsistent, and shaped more by instinct than oversight. A single misjudgment could topple a promising business. A burst of regional downturn could wipe out entire credit networks overnight. And because these architects worked quietly without the protections or scrutiny of formal institutions, their collapses often went unnoticed until communities felt the consequences. Still, in those early years, their impact was undeniable. They filled the void left by rigid banking systems. They brought liquidity to places long ignored, and they demonstrated, perhaps more clearly than anyone else, that the story of American finance was never just about banks and laws. It was about people who stepped forward to build opportunity where none existed. These opening beats reveal a world in motion, shaped by innovators whose legacies have been largely forgotten. But the deeper story, the conflict between their ingenuity and the instability it created, was only beginning to unfold. As the informal credit networks expanded, their influence began to stretch beyond the small shops and rural towns they first served. Merchants who once relied solely on seasonal profits now depended on lines of credit crafted by these quiet financiers. Farmers, burdened by unpredictable harvests, turned to them for the loans that kept their fields alive. And in cities pulsing with new industries, entrepreneurs sought them out when traditional banks refused to take risks on untested ideas. The architect of American credit had become indispensable, even if their work remained largely unseen. But with growth came tension. Each lender operated according to personal judgment, balancing intuition with experience, yet bound by no shared standards. Some kept meticulous records. Others trusted memory alone. A borrower considered reliable in one town might be dismissed in the next. Disputes arose not from malice, but from inconsistency. A system built on human instinct struggling to scale with a nation expanding at breathtaking speed. Rumblings of concern first surfaced among local officials. They noticed patterns that troubled them. Borrowers trapped in cycles of short-term debt, businesses stretched thin by unpredictable repayment demands, and financiers forced to make risky bets simply to keep pace with the needs of their communities. The system, creative and adaptive, had become a patchwork that functioned brilliantly in good times but faltered sharply when economic winds shifted. And the winds did shift. A downturn in commodity prices sent waves of stress through rural regions. Farmers missed payments. Merchants delayed orders. The private lenders who had supported them suddenly found their own reserves thinning, without institutional buffers or government support. Even a brief recession created cascading failures. One missed repayment led to another. Ledger books filled with red ink. Local economies grew tense as borrowers and lenders alike confronted the fragility of their arrangements. The strain deepened when rumors spread that some financiers had overstated their reserves or extended loans far beyond their means. Whether true or exaggerated, the whispers eroded trust. Borrowers hesitated to take on new credit. Lenders tightened terms, hoping to protect themselves from widening uncertainty. As each actor acted in self-preservation, the entire network slowed, exposing its vulnerability to fear and doubt. Newspapers seized on the instability, publishing stories of ruined shopkeepers and collapsing lending circles. Some painted the financiers as opportunists. Others defended them as victims of a broken system. But the narratives shared one theme. The country's financial scaffolding had grown too complex to rest on personal judgment alone. The absence of structure was no longer simply a quirk of early American finance. It was becoming a national risk. This mounting tension set the stage for a deeper conflict. The architects of American credit had proven their value, but they had also revealed the limits of a system built outside formal oversight. The question now was not whether reform was needed, but who would shape it, and at what cost to the independence that had defined their work for so long. The conflict erupted as the credit networks pushed past their natural limits. What had once been an improvised system of resilience now strained under the weight of a nation, expanding faster than its financial tools could adapt. Every weakness that could be tolerated in quiet times became a threat when the economy faltered. And as stress rippled across regions, the forgotten architects of American credit found themselves at the center of a crisis they never intended to create. The first fractures appeared in bustling commercial hubs where merchants depended on steady financing to replenish inventory. When lenders tightened terms, shipments slowed, store shelves thinned. Customers hesitated to spend, sensing uncertainty in every hesitant conversation at the counter. Businesses that had survived for decades now teetered, not because demand had vanished, but because the web of credit beneath them was unraveling thread by thread. In rural communities, the situation grew even more urgent. Farmers who had relied on short-term loans to carry them between planting and harvest suddenly faced mounting pressure. A missed payment, once resolved through handshake agreements, now triggered cascading consequences. Livestock was sold prematurely. Equipment lay idle. Families who had spent generations cultivating the same land found themselves debating whether they could afford to continue. Their lenders, many of whom were neighbors or long-trusted acquaintances, carried the burden of choosing between compassion and solvency. Inside city offices, the financiers themselves fought rising panic. Ledger books revealed widening gaps. Promissory notes once backed by reliable income streams now looked precarious. Those who had long believed in their ability to read character and gauge risk discovered that intuition could not shield them from systemic tremors. Rivalries emerged as lenders blamed one another for pushing the network too far, extending too much credit, or demanding too little collateral. Their cooperation, so vital to the system's survival, began to fracture under the weight of fear. Policymakers could not ignore the chaos. Congressional hearings gathered testimony from merchants, farmers, local bankers, and lenders themselves. The testimonies painted a sobering picture. An economy that depended heavily on institutions with no shared structure, no uniform protections, and no means of coordinating responses when stress intensified. Reformers argued that the nation stood on a precipice, risking widespread collapse if action was not taken. Opponents, wary of federal intrusion, insisted that regulation would crush the entrepreneurial spirit that had built these networks in the first place. Public frustration simmered into open discontent. Newspapers published stories of families ruined by abrupt credit withdrawals and of lenders driven to bankruptcy by cascading defaults. The narrative sharpened the divide between those who believed the system offered opportunity and those who believed it had become a quiet threat. Credit, once the hidden engine of America's growth, was now seen as both lifeline and liability. The tension reached its peak when a prominent lending circle collapsed without warning, leaving dozens of businesses stranded and sparking panic across neighboring regions. The failure confirmed what many had feared but few had spoken aloud. The system was no longer merely strained. It was collapsing under its own improvisation. And in that collapse, the nation confronted a troubling truth. The architects of American credit had built bridges no one else would build, but they had also woven a fragile web that could not endure the pressures of a modernizing economy. The stage was set for a decisive reckoning, a moment when the country would have to choose between preserving a familiar but flawed system or reshaping it entirely for the world that lay ahead. The reckoning came swiftly after the collapse of the lending circle, sending shockwaves through communities that had long depended on the quiet work of informal financiers. Merchants found their credit lines frozen without warning. Farmers who expected modest extensions were met with silence or impossible terms. The collapse did not stop at balance sheets. It spread into daily life, shaking confidence in ways that numbers alone could never capture. What had once been a hidden engine of opportunity now revealed itself as a fragile structure unable to withstand the accelerating pace of change. As panic rippled outward, policymakers recognized that piecemeal solutions would no longer suffice. Hearings that had once been exploratory now carried an urgency shaped by public anger and economic pain. Testimonies laid bare the system's flaws: inconsistent lending practices, inadequate reserves, and dependency on personal judgment vulnerable to rumor and downturns. Reformers pressed their case with renewed force, arguing that the financial future of the nation could not rest on institutions that crumbled under pressure. Their momentum grew as more communities felt the shock. Newspapers published stark accounts of shops closing, farms auctioned, and families left without the means to rebuild. The outcry shifted from frustration to demand. Citizens no longer asked whether something should change. They insisted that it must. The forgotten architects of American credit, once hailed as indispensable, were now symbols of a system stretched beyond its limits. Legislators moved toward creating a standardized framework, one that imposed oversight, established reporting requirements, and set minimum reserves to cushion against economic shifts. Critics fought to preserve the independence that had defined the early credit networks, warning that regulation might stifle the ingenuity that had fueled growth. But the evidence of collapse was overwhelming. The need for stability, transparency, and shared safeguards had become impossible to dispute. In time, new laws took shape. They did not erase the legacy of the informal lenders, but redefined it. Their innovations became the foundation for more structured credit systems. Their failures shaped the boundaries of reform, and their experiences, both triumphs and missteps, guided the nation toward a future where lending would no longer hinge on the fragile balance between personal reputation and economic fortune. Looking back, their story reveals a paradox at the heart of American finance. Progress often begins in the shadows, built by individuals willing to take risks long before the rest of the country realizes it needs them. But lasting stability requires more than courage. It demands systems capable of supporting ambition without collapsing beneath it. What happened to these early credit architects isn't just history. It's a reminder that every financial system must evolve or break, and that the structures we rely on today exist because someone learned those lessons the hard way.